Mr. Sharma, great to have you on the show. Thanks as always for joining on ET Now. Despite the O2 diversion and the second wave related lockdowns, you yourself have managed to clock in a 20% output growth. This is better than what the industry average has been. How do you think you managed to aid this performance and what really propelled it?
Yeah, thank you very much. As you know, JSPL is primarily in the infrastructure steel manufacturing. So we produce most of the steels and most of the products are meant for infra projects. So infra was doing well, MSMEs were also working very well, and over and above, we could maintain a very robust export book. And that has led us to produce 2.03 million ton production, which is 20% higher than the last year. And sales is also 3% higher. In fact, we could do 20% sales increase also, but we had a lot of inventories piled up at the port because of a cyclone, in the last month it came on the East Coast, and the inventory was lying there and we were unable to get the vessels. Otherwise, it would have been 20% increase in production and same 20% increase in sales. But still, we could manage it well, and hopefully we'll continue to do the same progress in times to come.
Post the months of April and May, have you continued to see a rebound in demand, Mr. Sharma? Because you've posted a 3% rise in the sales volumes. Where is it coming in from?
You see, primarily it is a plate business which is driving. The other is the driving factor internationally was Europe, and followed by some of the Middle East countries and Southeast Asian countries. So export spot market was superb. And again, we have seen that there was a little pessimism for about 10 to 15 days, but the demand has picked up again. The two factors where the cost inputs are going up, one is coking coal prices, the other is the iron ore prices. Perhaps this is first time in the history, in so many decades, that the iron ore and coking coal prices have equalized. So this $220 of iron ore and $230 of coking coal today. So these two major inputs, they drive the prices and they drive the economy as a whole. So this is the reason the prices have also gone up, input costs have also gone up, and finally the customers are in a buying mood. So for the last 3-4 days, we are seeing that the Chinese future is going up, and we are also seeing a lot of demand coming from Turkey, from Middle East, from Europe, and also from Canada. So this is a good sign.
Mr. Sharma, what is the outlook when it comes to steel prices? Because over the last few weeks, there has been that dip. Is that something you've witnessed as well?
Yes, the steel prices, there are three categories. One is hot rolled coils, the other is plates, and the next is construction steel. So the construction steel in India, it is under pressure. Of course, now also it is under pressure. As I told you, all indexes and indices are telling that the prices will rebound. The construction steel prices were under pressure because of two reasons primarily. One is a lockdown in many of the states, and which has forced people to go to their home state or hometowns. And the other is rainfall in many of the areas. So I think by the end of this month, by the end of July, situation will become normalized. And, country has declared that each and everybody who is 18 plus is going to be vaccinated. So this is a very good sign, because whenever there were some disruptions because of COVID or because of any wave, so all these workers, they were going back, or they were not coming to the sites. So I think after vaccination, most of them will be confident to resume their work, and people will be available to complete the project sites. So I think the production as well as sales for construction steel also will improve maybe in next 10 to 15 days time, and the prices will also improve. We are expecting a price increase of about 1,500 rupees to 2,000 rupees per ton in the construction steel bars, especially rebars, and also for the structural steel within India. And also at international level, for the last 3-4 days time, China has come back to buy semi-finished steel, that is billets, blooms, and slabs. So that has also created an impact on the domestic prices in India. So I think the prices are going to rebound because all of the indexes are showing the positive or the higher side of rally. So be it scrap, be it HBI, pig iron ore, and coking coal.
We're also hearing from dealers that long products are seeing inventory build up. Can you shed some more light on that? Do you believe it's just a temporary phenomenon that's been created due to the second wave?
Yeah, it is a temporary phenomenon, but the inventories are very less with the dealers also. On pan-India basis, as per the information I have gathered, the total stock is about 2.5 million ton for the construction steel, which used to be about 4 million to 4.5 million ton. So this is a very nominal stock. I would say it is a moderate stock. The moment the construction activity they restart, immediately this stock would be lifted, and the traders and the dealers they will come back to buy more and more steel, more and more construction bar. Yes, for next 1 week or 10 days time, people those who have additional or high inventory levels, they will be in a position to salvage it, or they'll be in a position to sell it at a better price. But the prices are going to rebound. It is a temporary phenomenon. These are going to rebound.
Sure. Mr. Sharma, what I also wanted to understand was, when does the zero-cost Sarda iron inventory get exhausted for you? And how do you think it's going to impact the margins, given that NMDC now itself is charging close to about 7,000 rupees per ton for iron ore?
The material which was lying with Sarda mines is almost finished. I think another 15 to 20 days time will be completing this complete stock. And we have more than 3 million ton of stock lying within the plants at various locations. So there is no shortage of iron ore. Secondly, the merchant miners, they are now offering more and more iron ore, because due to monsoon, the export activities, they go down, and they also bank upon the domestic buyers. So we are one of the major buyers in Odisha and also in Chhattisgarh. So we have no problem in sourcing the iron ore. The other point, what we are discussing with government of Odisha, they have a preemption policy which is existing since 2014. And that ensures the raw material security for the investors, those who are invested in the state of Odisha, like JSPL and like many more companies. So I think OMC and the merchant miners will be asked by government of Odisha to fulfill the domestic demand first. Domestic means here, the domestic means the Odisha-based industries, steel industries, they should be given the first right of refusal when they are buying iron ore. So if that is coming into force, or that is reactivated, then there will not be any shortage or any dearth of any iron ore.
Right. Coking coal prices have spiked up quite massively. Just wanted to understand, what is the cost of production that you have seen? And also, your EBITDA margins in the fourth quarter were already at record levels. In the first quarter, could we see that continuing? Or do you see signs of peaking out?
Yes, you are right. The coking coal prices are shooting up. But as I told you, the input costs versus the sales price, they are matching with the fixed EBITDA. So there is no pressure on EBITDA at the moment. Whatever EBITDA level we maintained in quarter four, that will continue, except for the benefit what we have booked on account of iron ore, which was duty paid and fully paid, which was lying in SMPL for the last 6 years. So minus that particular benefit, each and everything in terms of profitability, EBITDA levels will be maintained. So we are working very closely that we should be in a position to fulfill our annual target, that is 15-15-50, which shows that 15,000 crore or plus of EBITDA, 15,000 crore or below is the total debt, and 50,000 crores, that is 50,000 crores of sales turnover. And we are in line with that. So we have done 2.03 million ton production in the first quarter. We will be will be achieving at least 8.2 million ton sales and production in the entire year, as against 7.51 million ton last year. So if you see in last 3 years, from 5.5 million ton, we reached to 6.3, and from 6.3, we reached to 7.5. And now this year, hopefully, we'll reach to 8.2 million ton, which is a more than 58% growth in last 3 years. So this is going to be the success story of JSPL, and we'll be in a position to maintain EBITDA level as we have been maintaining the last 1 year time.
Okay, Mr. Sharma, that's fairly heartening to note, but you've also announced a new round of capex plans, and a lot of other steel companies have as well. Now, 4 to 5 years down the line, when we see all these capacities commissioned, what gives you the confidence that Indian demand will be able to absorb all these new capacities?
That's a very right question. Government of India has laid a program that 300 million ton steel is required by 2030 by Indian citizens in the country. Out of that, maybe 30 to 40 million ton, that is 10% of the total production, will be exported. Balance 270 million ton will be consumed within the country, which is a very fair calculation, I would say. And we support this calculation because China, with the 1.5 billion, they are consuming 950 million ton of steel. So we also we are going to reach 1.4 billion or maybe 1.42 billion. So we can definitely consume 270 to 300 million ton steel, which is a very moderate target for the nation. And this also shows that Government of India is committed to invest more and more on the infra projects. So the DPR is under preparation for linking of the rivers, and more and more railway tracks are being laid in the country. More and more national highways are going to be built in the country. More and more ports, more and more sea to earth linking bridges are being manufactured. More and more rapid train and transmission system is coming in the country. That means more and more steel will be used. Government of India has also liberalized the defense equipment building facilities. So this will also bring many private sector industries to produce and to manufacture warships, submarines, and merchant ships as well. So this will definitely increase the steel consumption in the country. So now coming back on the capex, the 5 big players in India, those who are in 5 million ton club today, they want to double their capacities in next 5 to 6 years times. So today these 5 players, they produce more than 56 million ton steel. And in next 4 or 5 years, we all will be producing about 110 or maybe 115 million ton steel. So the secondary sector is producing about 40 million ton steel as of now. So put together, our capacities will reach to approximately 180 million ton. So there is still a gap of about 120 million ton. I think Government of India will have to invite the FDIs and the multinational companies, those who can come and put up their factories here in India, and we can reach to a level of about 300 million ton by 2030. So it is more a country's need and country's demand than a steel industry's is appetite. So as far as JSPL is concerned, we have declared that earn and invest is our philosophy. Whatever accruals will be there on year basis, we'll be reinvesting, redeploying back into our system, and we will not be borrowing any money to go for the expansions. So that is going to be the strong point of JSPL. So the theory is very simple: earn and invest. So whatever profit we are going to earn, PAT we are going to earn, we'll try to flow back in the system, and that's all. We'll not be keeping ourselves under burden as we were in 2016 or 2017. We do not want to reach to those levels anymore.
Okay, thanks very much, Mr. Sharma, for shedding more light on the overall demand situation and what the outlook has been on steel prices as well as your capex.